Thank you. Mr. Oaks, you are now recognized.
Chairman Smith, Ranking Member Neal, members of the committee, thank you for inviting me to testify before you on the impact of ESG on retirement security. Masquerading as a sophisticated, holistic, and enlightened way of creating shareholder value, ESG is a dangerous investment scheme. Proponents of the framework argue ESG is designed to provide investors with more information to make better informed decisions. This is misleading. In truth, ESG has created an uncontrollable impulse to pressure corporations to solve complex global and societal issues. These issues, such as climate, income inequality, guns, and abortion, to name just a few, should be in the purview of a democratically elected government. ESG hijacks corporate governance to advance ideological objectives often divorced from and even detrimental to long-term shareholder value. It opens the door to coercion, bullying, and other forms of compulsion by activist shareholder proponents with little skin in the game. This happens in collusion with and the assistance of the foreign-owned duopoly of ISS and Glass Lewis. They are joined by large institutional shareholders who manage billions of dollars in state-owned pension funds. The goal of ESG is not better financial performance. It is to force compliance to one view. The ESG trend that has infiltrated our capital markets will undermine our free market system, harm our economy, and erode the retirement security of hardworking Americans. ESG is incompatible with free markets. The E in ESG is focused on pursuing net zero carbon emissions. However, the primary objective is to transform the global economic system. Just ask Christiana Figueres, who oversaw the writing of the Paris Climate Agreement. She said in 2015, the true goal of pursuing climate change initiatives is to abandon the economic model that has been the engine of global growth for 150 years. In fact, a United Nations commissioned report in 2018 predictably concluded, we cannot fight climate change with capitalism. The markets allocate capital to environmental solutions by investing in innovation. However, when politics force an ideological agenda and get enough participants to behave one way, markets stop functioning. The buying and selling of the same security on any given day requires different views about the future, or trading will not happen. ESG dangerously moves the market to one view, the perspective of a small group of like-minded individuals that is generally subjective and controversial. Simply put, ESG destroys markets. ESG politicizes financial decisions. Americans put their trust in investment managers to grow their money for important savings goals like retirement, education, and future emergencies. Investment managers have a fiduciary obligation to focus solely on creating returns for investors. In 2022, the Department of Labor foolishly loosened this fiduciary standard. Plan sponsors and investment managers now have a safe harbor to use politically motivated investment strategies in retirement plans as a default option. When a manager tries to achieve a dual purpose, there is the significant risk that returns will suffer or volatility will increase. Indeed, academic researchers surveyed 1,141 primary peer-reviewed papers and 27 meta-reviews based on about 1,400 underlying studies published from 2015 to 2020. They found a statistically significant negative relationship between ESG investing and investor returns. New federal regulations, proposed regulations, and the regulatory approach to applying existing regulations support activists inserting their ideological agendas through corporate proxy ballots at annual shareholder meetings. Yet many asset managers are supporting shareholder proposals related to ESG issues, such as racial audits and fossil fuel restrictions, even within non-ESG investment vehicles. In the vast majority of cases, these proposals are driving environmental, social, and political agendas that are not aimed at furthering shareholder value. In fact, multiple research studies have shown ESG-related proxy measures often have a detrimental effect on financial returns. In conclusion, ESG represents the greatest threat to our economic engine, which has produced more innovation, wealth, and opportunity than any other economic system in the history of the world. And that is the real problem with ESG. We will either have ESG and the economic coercion that system ushers in, or we will maintain our economic freedoms. Thank you.